The current financial crisis in the United States has had many different consequences. When large financial institutions collapsed, the number of unemployed people increased, and therefore our gross domestic product, or GDP, decreased because we were producing and exporting fewer goods. The government created a troubled asset relief program in October 2008 and invested money in these large banks and industrial corporations, hoping that they would stabilize financial markets. 1 year later, President Obama then passed an additional $700 billion stimulus in an attempt to create jobs. This economy bailout, however, has not provided all the jobs that were expected. Citizens instead steadily continued to lose their jobs, and as work was unavailable, the nation's GDP official exchange rate began to decrease for the first time in decades, and the nation was only going into further debt. By the end of 2009, the GDP was $14.1 trillion, and at this time our external debt was $13.5 trillion. This debt is currently the most owed by any country in the world, and it is increasing at an exponential rate. Since the financial crisis began in 2007, the nation's GDP began to decrease all the way until the end of 2009. Over the past 2 decades, the nation's debt has increased so drastically that it is now almost equal to our country's annual salary. Increasing from $3.2 trillion in 1990 to almost $14 trillion in 2010, the future of our national debt is not in a good situation. If this trend continues, the U.S. might have the biggest financial collapse any country has ever seen. From 2007 to 2009, the U.S. was in its longest and deepest recession since the Great Depression. Even with a per capita GDP of $46,000 and one of the largest and most technologically advanced economies in the world, we still have to figure out a way to slowly climb out of debt. The U.S. currently has a very low real GDP growth rate, which is its annual income adjusted for inflation and expressed as a percent. In 2009, this was at negative 6.4%, decreasing from 3.6% in 2007, and was 160th in the world in this area. All of these different categories of GDP only show that the reason we have so much national debt is that our total production has declined drastically compared to our consumption. Bringing the job market back to encourage production is the only way to bring our country out of debt. The Great Depression lasted a full decade, from the stock market crash of 1929 to the beginning of World War II in 1939. Unemployment went above 25% and the country's total production was cut in half. If the United States can survive that, then we will certainly overcome our current financial crisis.